Module 10, the Project Feasibility Study, the Financial Analysis. In our previous module, we learned about how to prepare the technical and operational analysis for a development project. We also learned about how to estimate the costs in development. In this module, we will focus on the financial part of the project feasibility study and use the data we have gathered from the previous sections in order to determine whether or not the project is financially sound. This module has the following objectives. First, to be able to define what a financial analysis is and its purpose. Second, to familiarize oneself in the different tools and methods used in a financial analysis. And third, to be able to prepare a financial analysis section of a project feasibility study for a particular development. Financial study. Financial study basically answers the question, will this real estate project be profitable? And by how much? Financial analysis is the process of evaluating businesses, projects, budgets, and other financial related transactions to determine their performance and suitability. Typically, financial analysis is used to analyze whether an entity is stable, solvent, liquid, or profitable enough to warrant a monetary investment. A financial analysis in real estate entails preparing an accurate development cost estimate, forecasting revenues, and measuring profitability using appropriate investment tools or criteria. Basic steps in financial analysis. These are the general steps followed in the preparation of a financial analysis in a project feasibility study. First, make an estimate of the project development cost, as well as, if applicable, the operating expenses. Second, forecast revenues and net income over the life of the project. And third, apply investment analysis tools and criteria to determine profitability. We will discuss the three steps in detail in the next slides. Step 1. Estimate of project cost. Project costs includes the following. First is land, either its current value or the acquisition cost adjusted to the timeline at the project inception. Second, development costs, which includes design, construction, project management, financing, and other related costs. And third, operating expenses, if it is applicable. Valuing land. Here, we use conventional appraisal approaches, usually the market data approach. Land value can also be estimated using a competitive market data approach, in which knowledgeable brokers are requested to provide market data about current prices and trends. After which, we have to apply corresponding adjustments considering the project timeline. Development costs. The nature of the project dictates the cost components. Subdivision projects involve site development costs for earthwork, roads, utilities, and others. Vertical projects, on the other hand, like condominiums and buildings, involve the cost of structure, architectural finish, and the utilities. We have to consult experts if necessary. project funding options. After coming up with a total project cost, we now have to think about where we are going to find the money to finance the project. Here, we have three options. We have land joint venture, bank or institutional financing, and syndication. Land joint venture is a partnership with the landowner who contributes the land while the developer or the project proponent contributes all other developmental costs. Here are some considerations to think about. First, the landowner's share of the profit. Second, the type of agreement or organization structure, or how the ownership of a project will be divided. Third is the time frame. And fourth, conditions governing the default of the developer in case the project is not completed. We could also go through conventional financing. Here, we look at banks or institutional financing institutions. We could get a short-term loan or get a credit line from commercial banks. Even the government's Pag-ibig program, managed by the HDMF, offers development financing for property developers. Here are some considerations to think about. What is going to be used for collateral for the loan? Also, at what ratio will the loan be to the total project cost? You also have to think about the loan term and tenor. One must consider at what rates should it be fixed or should it be free floating. The third option is syndication. Syndication is where several different entities will pool their funds together for a large-scale real estate project. But there are some considerations. For example, the organization structure. How many board seats will each investor get? The types of corporate shares, profit sharing, and many others. Step 2. Forecasting revenues. Here, we forecast the revenues of the project depending on the type of model used. First, for the build and sell model. The initial step is to prepare a project profit and loss statement. It is here we determine the revenue, which is based on the projected sales of our real estate products, which is a result of our marketing study. Then we determine the costs, both for the land and the development costs. The development costs we were able to estimate from the technical analysis part of the project feasibility study. Then we compute for the profit, which is the revenue less the costs. Next, for the build and rent model. It is similar to the build and sell model wherein we also prepare a profit and loss statement. Here, our revenues come from the rental or room sales for the duration of the life of the project. Then, we compute for the expenses, such as the operating and administration expenses. From there, we get the annual net operating income, which is equivalent to revenues less expenses. But we also have to look out for future renovation costs in the cash flows. In mixed-use projects, we combine both models. Some parts are sold, other portions are leased. Here, the capex or development cost is apportioned correspondingly between the for sale and the for lease portions. There are two stages in the projected cash flows. First is the selling stage, and then the next is the leasing stage. The cash flow analysis for the build and sell portion is usually shorter, about, say, 5 years. On the other hand, the analysis for the leasing model will take a longer period, anywhere from 10 to 20 years. Note that in forecasting revenues, we should consider the impact of debt service. Here, we have to adjust the cash flow forecast correspondingly to the debt service. While the net present value will be reduced because of amortization, there will be an equity build-up every year. And at the end of the loan period, equity will reach 100% value, and there will be a reversion value. Notes on depreciation and taxes. In general, depreciation and income taxes are not included in basic financial analysis. Depreciation is a non-cash item and is not included in the cash flow analysis. The IRR, or internal rate of return, is presumed to include a recapture rate for improvements. In addition, income taxes are excluded because an entity could have a different tax bracket from others. Step 3. Applying financial analysis tools. The first step in analyzing the project's financial outlook is to prepare the projected financial statements. First is the cash flow statement. This is a statement that shows physical money moving in and out of your business or your project. You base your cash flow statement partly on your sales forecasts, balance sheet items, and other assumptions. Existing business or projects should have historical financial statements to use to project the cash flow. New projects or businesses, on the other hand, should start by projecting cash flow statements that is broken down into 12 months. Next to prepare is the simplified profit and loss statement. This details the forecasts for the profit and loss for your business or project. The duration will depend on the life cycle of your project. Use numbers that you put in your sales forecast, expense projections, and cash flow statement. The net profit is gross margin minus expenses, interest, and taxes. And finally, if necessary, prepare a simplified balance sheet to detail the assets and liabilities of the project. After preparing the different financial statements, we now could use the different financial analysis tools we have learned in the previous modules. First are the profitability ratios. We could compute for the return on equity of the project. Again, ROE is the ratio between net income and equity capital. The formula for ROE is equal to net income divided by equity. Take note that equity is the investor's actual capital and does not include debt. Next, we could also compute for the return on investment, or ROI. ROI is the ratio between net income and total investment, or CapEx. The formula for ROI is net income divided by total capital. Capital means the total amount invested in the project, which includes both equity and debt. Another popular profitability ratio is the payback period. Payback period is the ratio between total equity and net actual income. Payback period is equal to equity divided by the net operating income. Note that the payback period is also in effect the reciprocal of ROE or return on equity. After computing the profitability ratios, now we analyze a project using discounted cash flow analysis. For single sum cash flows, we use the single sum discount factor. And this is the formula. SDF is equal to 1 over the quantity 1 plus R raised to the n, where SDF is equal to the single sum discount factor. And if F1 is equal to 1 plus R or raised to the n, remember that F1 is our compounding or future value factor, the SDF is equal to 1 over F1, where R is equal to the rate and N is equal to the periods. For multi-stream cash flows, this is the formula for the discount factor. MDF is equal to the sum of 1 plus R raised to the N minus 1 over R plus the quantity 1 plus R raised to the N. If F1 is equal to the quantity 1 plus R raised to the N, and F2 is equal to the quantity F1 minus 1 over R, remember that F2 is our annuity factor or the future value of an annuity, then the MDF is equal to F2 over F1. And if you also will recall, the MDF is equal to F4, or the present value of an annuity. Again, R is equal to the rate, and N is equal to the periods. Next, we could also compute for the internal rate of return, or IRR. This is the procedure. First, all future cash flows are discounted to the present value. Next, we use a trial interest rate, or R. Third, we adjust the rate until the net present value is equal to 0 or close to it. The rate at which the net present value is equal to 0 is the IRR. At the IRR, the total present value of inflows will equal all outflows. We could also compute for the following. Tests for liquidity. We could compute for the current ratio, which is equal to the current assets over current liabilities, or look for the asset test ratio, which is equal to the cash divided by current liabilities. We could also conduct tests of debt service. We could compute for the debt to equity ratio, which is equal to the total liabilities divided by the total equity. And we could also look at the total capitalization ratio, which is equal to the long-term liabilities divided by the long-term liabilities and equity. We could also look at the tests of operating leverage. Here we look at the fixed and variable costs, and we also try to look for the break-even analysis, where we compute for the break-even volume, break-even cash, break-even selling price, and break-even sales analysis. We could also compute for the following and compare to similar companies or projects. Tests for liquidity. Here, we look at the current ratio of the project. We compute it using the current assets divided by the current liabilities. We also look at the asset test ratio, which is equivalent to the cash and its equivalents divided by the current liabilities. We also look at the ratios for debt service. One of the most popular is to the debt to equity ratio, which is equal to the total liabilities divided by the total equity. And we could also look at the total capitalization ratio, which is long-term liabilities divided by long-term liabilities and equity. We could also try to analyze the tests of operating leverage. Here, we look at the fixed and variable costs, and then we do a break-even analysis. We could do a break-even sales analysis by getting the break-even volume, the break-even cash, or the break-even selling price. We could even go further by looking at these ratios. First, we could also look at the test of financial leverage, which are the earnings per share or EPS, and the dividends per share or DVS, and try to see if these would merit the approval of the investor based on their preferred return. Then we could also look at the test of capital investment. Here, we look at the average rate of return, the payback period in years, the capital recovery, or the cash payoff period in years. Now that we know most of the financial analysis tools used for financial analysis, here are the most common decision criteria used in real estate project feasibility studies. First, the payback period, which is the number of years required to return the initial cash investment. Second, the net present value. Using the investor's required rate of return, we convert all future cash flows to present value and subtract the initial investment. The net present value or NPV should be a value greater than the initial investment. Next is the benefit cost criteria. This is the ratio of the NPV over the investment, and this is a profitability index. Finally, we have the IRR, which is the internal rate of return. This is the rate of return at which the NPV or the net present value is equal to zero. We compare the IRR to that of industry standards and if it meets the criteria of the project proponent. If it is higher, then the project is a go. If it is lower, then we don't go on with the project. Finally, after preparing the financial statements and making an analysis using the different tools, we have to conduct a sensitivity analysis. It is here we explore the financial impact of alternative assumptions. Some scenarios to look at are the following. First, what if the funding used is purely equity capital? Or second, what if the funding uses a combination of both equity and debt? Then we could also check the effect of various levels of annual sales or the various levels of occupancy. We could also look at or check the various levels of development costs or various levels of operating expenses and see its effect in our ratios and cash flows. And that ends Module 10, the Project Feasibility Study, Financial Analysis. You could check out the following references for further information. Thank you.